Andy Panko, owner of Tenon Financial. Welcome to Retirement Planning Demystified. Let's talk about gifts, specifically the tax implication of giving and receiving gifts. Well, part of that is easy. Gifts are never taxable to the recipient. However, as the donor or gift giver, there's a lot more to it. I'll explain. But first, be sure to like this video and subscribe to this channel so you can be notified when I release additional videos. Before we start, remember this video is only general explanations and education. It's not specific tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor. There's one huge distinction I need to make up front between gifts and charitable donations. When you give something of value, such as money or clothes or a car, to a certain type of qualified organization, that's a donation and may be eligible for a tax deduction. Like if you give cash to a church, university, your local volunteer fire department, or a qualified nonprofit charitable organization like the American Red Cross, it's a charitable donation and it's eligible for a tax deduction. This video is not in reference to charitable donations, it's instead about all other forms of gifts like giving something to your friends, family, or even random strangers. Let's first start by defining what a gift actually is. The IRS defines a gift as a transfer, either directly or indirectly, of any kind of property where full consideration is not received in return. There's a lot to unpack in that little sentence, so let's break it down. First, what's a transfer? That's basically just the act of passing your ownership of something to someone else. And what does it mean to be direct or indirect? That's easy to understand in the case of a physical thing like a box. Like if I have a box and I give it to you, I just transferred it to you, and I did it directly because it went straight from me to you without any ambiguity. But what's an indirect transfer? An example would be if you borrowed money from me and you're supposed to pay me back. If I choose to waive your requirement to repay me, I just gave you something. Specifically, I just gave you the benefit of not having to pay me what you otherwise were supposed to. That's an indirect transfer. And it's a gift because I gave you something of value. Next, what is property? Property can basically be anything. It can be a physical thing like a car or a house, or it can be a financial thing like cash or even shares of a stock. And finally, what does it mean to not receive quote-unquote full consideration in return? The word consideration just means what you get in return for giving someone something. Like if you work and receive wages, the wages are the consideration for the services you provide. Or if I go to the store and buy a pair of shoes, the shoes are the consideration I receive for the money I give to the store. Neither of these examples are gifts, because I'm receiving full consideration for what I'm giving. A gift is when you give something of value to someone and receive nothing in return. Or maybe you do receive something in return, but the value of that something you receive is less than the value of what you gave. In that case, you would not be receiving full consideration, and therefore you will be deemed to have made a partial gift. Let's look at a few quick examples of gifts and their values. The easiest scenario is if you give someone $10,000 in cash. It's clear you made a gift, and the value of that gift is easy to figure out. It's $10,000, no more, no less. What if you instead give someone an old car? What's the value of that? This is where things start to get a little more involved. The value of the gift, the car in this case, is not the price you originally paid. Instead, it's something the IRS calls fair market value. Fair market value is fancy speak that just means what something is currently worth. Like in the case of a car, maybe you bought it new 20 years ago for $30,000, and now its value is only $2,000. If you give that car outright to a friend and receive nothing in return, the value of the gift is a $2,000 fair market value, not your original $30,000 purchase price. Let's take things a step further. What if you sell something to someone, but you sell it for less than its fair market value? Well, that would be a partial gift. As an example, assume you own your home and it's currently worth $500,000. If you were to sell that to your child for a below market price of only $300,000, as an example, that would be a transfer for less than full consideration. Because in this case, full consideration would be $500,000. Since you only received $300,000, you effectively gave a gift of $200,000, which is the difference between the fair market value and the sales price, or the amount of consideration you received. As you can see, determining the value of gifts can get complicated pretty quickly. This is especially true with physical property when giving partial gifts. With that said, the valuation of all the possible types of gifts is beyond the scope of this video, so we'll just stick to some basic examples here. Now that you know what a gift is and how to start to determine its value, what are the tax implications? First, it's important to know that the person receiving the gift never has to pay any tax on it, regardless of the size or value of the gift. However, Once the gift is theirs, they will be responsible for any taxable income that property subsequently produces. For example, if you give $10,000 cash to a relative, they don't have to pay tax on it when they receive it. But if they turn around and put it in a bank account that earns interest, they will have to pay tax on that interest. As for you, the donor or gift giver, chances are you won't have to pay any tax on the value of the gifts you give. But, depending on the size of the gift, you may at least need to file a gift tax return with the IRS. Even if taxes aren't owed, you nonetheless have to report gifts to the IRS if they are over a certain size. And here's why. The IRS lets you give away a certain amount of assets and property throughout your life without having to pay any tax on the value of what you gift. There's something called an annual exclusion amount. For 2021, the annual exclusion amount is $15,000. This means you can give up to $15,000 of gift to anybody you want in 2021, and you will not have to pay any tax on it, but you also won't need to file a gift tax return or otherwise report it. Furthermore, you can use the annual exclusion limit for as many different recipients as you choose. At one extreme, you can walk down the street with a huge stack of cash and literally hand out $15,000 to every person you pass. So long as you don't give more than $15,000 to any one person during the year, you don't have to pay tax on it and you don't have to report any of it. And like I said before, none of those recipients will have to report or pay any tax on those gifts either. It's only when you give more than the annual exclusion amount to a single person that you need to file a gift tax return, even though you most likely won't owe any taxes on it. I'll touch more on that in a bit. There's a couple of big favorable exceptions to be aware of. The first one pertains to married couples. There's no tax or reporting requirements on gifts of any size to your spouse. In other words, if you're married, you can give as much as you want to your spouse, even if the gift is well in excess of the annual exclusion amount, and you won't have to pay taxes or report the gift on a gift tax return. The second exception is gifts of tuition or medical expenses you pay for someone else, but only if you pay the expenses directly to the educational or medical institution. For example, assume your mother needs surgery that's going to cost her $100,000 out of pocket. If you give her $100,000 in cash and tell her to use it to pay for her surgery, that will be a normal gift and will exceed the $15,000 annual exclusion amount by $85,000. That will require you to file a gift tax return. If, on the other hand, you directly pay the $100,000 to the hospital on behalf of your mother's procedure, there are no special reporting or tax requirements. It's completely excluded. And it's the same story if you pay tuition for someone else. If you give the person money to turn around and pay their tuition, that's a potentially reportable normal gift. But if you instead pay the school directly, it's an exception to the reporting requirements, regardless of how much you pay. So, barring these few exceptions I just discussed, what happens if you give away more than your annual exclusion amount to someone in a given year? Well, that eats into the total amount of money you're allowed to give away during your lifetime before you start having to pay tax on the value of any gifts above that amount. Furthermore, the dollar amount of that lifetime limit is shared between gifts you give away while you're alive and property you transfer to others after you pass. Basically, the IRS doesn't want people of large means to be able to simply give all their wealth away, either in life or in death, without paying taxes on at least some of it. So they'll let you give away a certain amount, and then anything over that amount will be taxed. You may have heard of the Estate Tax Exemption. That's where when you die, so long as the value of all your assets and belongings is less than a certain amount, your estate will not have to pay any tax on the value of your stuff. But if the size of your estate is over that threshold, an estate tax will be owed on any amounts over that level. As mentioned before, the estate tax exemption limit is actually shared with the value of gifts you give away while you're alive. In other words, gifts you give away during life can reduce the amount of estate tax exemption you have available for when you die. This combined estate tax exemption and gift transfer limit is called a basic exclusion amount, or BEA, and is previously called the unified credit, which you may have heard of. Here's the current and historical basic exclusion amounts. For 2021, the basic exclusion amount is $11.7 million per person, and it's indexed to inflation such that this amount should tick up a bit each year, as it has over the past few years. One thing to be aware of is that there's one big looming change in these amounts related to the Tax Cuts and Jobs Act, which became effective in 2018. The basic exclusion amount was doubled starting in 2018. However, it's set to revert back to its prior level plus inflation increases in 2026. In other words, the BEA will be cut in half once the calendar switches from 2025 to 2026. Furthermore, like all tax legislation, it may potentially change or reduce sooner than 2026. And as you can see in this chart, the basic exclusion amount was as low as $1.5 million per person in the not too distant past. So who knows what the BEA may look like in the future. Stay tuned. Let's look at how the basic exclusion amount works. We'll assume it's 2021 and you haven't yet eaten into your basic exclusion amount at all. Let's assume you give $10,000 to each of your 2 children and 1 niece. Because each of these gift amounts is under the annual exclusion amount of $15,000 per recipient, they don't use up any of your BEA. And furthermore, you don't have to do any special reporting to the IRS or anyone else about these gifts. So all said and done, other than you now having a slightly smaller bank account from having made these gifts, the whole thing is a non-issue as far as the IRS and your tax return goes. And your BEA remains $11.7 million. Let's now look at a slightly different example. Again, assume it's 2021 and you have not yet used up any of your BEA. Let's assume you're feeling really generous and you decide to give your house to a friend. And your house is currently valued at $715,000. In this case, the value of the gift is $715,000, which is clearly over the $15,000 annual exclusion amount. But how much of it do you have to actually report to the IRS? Well, thankfully, the IRS will let you first subtract out the annual exclusion amount. In this case, subtract out that $15,000 annual exclusion, and you're left with a gift of $700,000, which is the amount by which you will need to reduce your BEA. In this case, you started the year with your full $11.7 million basic exclusion amount, but now you give away a gift of $700,000, so you only have $11 million of BEA remaining going forward. What does that mean? Well, after accounting for annual exclusion amounts each year, you can still give away another $11 million of stuff prior to starting to have to pay tax on your gifts. Or, if you were to die tomorrow, the first $11 million value of your estate would be tax-free, but any estate value you have above and beyond $11 million would be assessed an estate tax. There are a few other important things to mention here relevant to married persons. First, the $15,000 annual exclusion amount is per recipient per donor. For example, if you're married and you and your spouse have a child together, each you and your spouse can separately give your child $15,000 such that your child receives $30,000 in total, but you and your spouse stay within your respective annual exclusion amounts. There's no special reporting requirements and neither of you eat into your lifetime basic exclusion amount. If you plan on doing something like this, where both you and your spouse want to maximize what you give to the same person, be sure you each separately give the recipient your gifts, even if the money or gift is coming from jointly owned assets. Using the same example, if you want to collectively give your child $30,000, it will be best to each separately give $15,000. Don't do it such that one of you gives $30,000. All gifts can only technically have one donor, even in the case of a married couple. Therefore, that $30,000 gift will be deemed to be from just one of you. Now, all hope is not lost in this case. There's something called gift splitting that applies to married persons. It allows you to, in effect, split a gift like this one into being half from you and half from your spouse. And in this case, you'd each stay below your respective annual exclusion amounts of $15,000. But whenever you elect to do gift splitting, you need to file a gift tax return. And that's more work and headache than is absolutely necessary. So in this example, it's much cleaner and easier to just each separately give your child $15,000. Also recall I said the lifetime basic exclusion amounts are per person. For example, the $11.7 million BEA for 2021 is for you. If you're married, your spouse also has an $11.7 million BEA this year. In essence, that means a married couple can give away, either as gifts while alive or estate transferred after their death, up to $23.4 million as of 2021. It's important to know that ever since 2011, spouses are allowed to port over their unused BEA to the other spouse upon death under something known as the Deceased Spouse Unused Exclusion, or DSUE. For example, if your spouse were to unfortunately pass away this year and did not use up any of his or her lifetime basic exclusion amount, that $11.7 million of unused limit can be given to you such that you can combine it with your own BEA and you would now have up to $23.4 million of BEA. Let's now talk briefly about gift tax returns. As I mentioned a few times, if you give away more than your annual exclusion amount, you are required to file a gift tax return, which is IRS Form 709. Additionally, like I just mentioned, if you and your spouse elect to split a gift, you will also have to file a gift tax return. The specifics of filling out this form are beyond the scope of this video, and this is just showing one of multiple pages of Form 709. As you can see, this thing can be a bear. The important thing to know is that even if you have to file a gift tax return, it doesn't necessarily mean you will owe any tax on your gift. Because remember that you only have to start paying tax on gifts you give if you give more than your lifetime basic exclusion amount. And considering that amount is currently well over $11 million, chances are you may not hit it. Though keep in mind that limit is expected to get cut in half in 2026 and may potentially get reduced even further. So then what happens if you do give away more than your BEA and need to start paying tax on the value of the gifts you give above and beyond that? Here's a summary of the current tax rates applicable to gifts larger than the lifetime basic exclusion amount. The tax rates are progressive based on how much you give over your BEA. The rate starts at 18% and increases to 40%. As you can see, if you give more than $1 million over your BEA, you'll start to have to pay a 40% tax on all subsequent gifts. Well, that's it. I hope you found this video helpful. I'm sure you're probably walking away with more questions than you knew you had, such as the complexity of the tax code when it comes to gifting. But hopefully this video nonetheless provided you a good overview of the basics. Be sure to subscribe to this channel so you can be notified when I release additional videos. Also, subscribe to my monthly newsletter, Retirement Planning Insights, which provides informative retirement planning tips and info. And be sure to join my free Facebook group, Taxes in Retirement, where you can learn all about tax-efficient retirement planning. Thanks for watching. I'll see you soon.